Hello, and welcome back to the latest episode of the Short Term Rentals podcast, now on episode 8. My name is Paul Stevens, news editor of Short Term Rentals, and today I'm speaking to Mickey Kropf, who is the founder and CEO of Vector Travel, which is a short term rental management company that partners directly with multifamily owners and property management companies seeking to monetize vacant units in stabilised or leased up multifamily buildings. Hi Mickey, how are you doing?
Hey Paul, I'm doing well. Thanks for having me.
And where are you joining us from today?
I'm talking to you from my home, or not my home, my home market, our headquarters in Jacksonville, Florida.
So as you know, today we're going to be talking about the impact that the pandemic has had on revenue, ADR and length of stay, the increasing need to diversify channels where operators are getting their bookings from, and also optimism for the future of the short-term rental industry beyond this pure survival phase. So Mickey, my first question is, how has Vector Travel been personally affected by the COVID-19 pandemic, and how have you been forced to adapt to this new environment, this new normal?
Yeah, thank you. We were hit pretty hard. So I should say we are a U.S. based company, and our inventory is in the U.S. So all of this data, and I think the timing of it that we'll go through is framed within the context of the U.S. I'm sure if we were to talk to an operator out of China, all of this would have been true just sooner. And so we were hit pretty hard. We were, of course, following the news globally. So out of China, then Italy. I would say we were a little slow to connect the dots, though, on what the impacts would really be here in the U.S. and in our markets. We're in about 25 different U.S. cities, and so in general, we feel fairly well diversified. But in the context of a global pandemic, of course, everybody in the lodging and travel industry more broadly was negatively impacted. So the day when it really hit me was the Friday of South by Southwest. So it was a very last minute cancellation. We operate in Austin, and we saw, all of a sudden the cancellation spike 7 to 8x of what normal cancellation data was. In fact, cancellations per day really wasn't even a KPI of ours. It wasn't something we tracked, just because it was always within a normal band and didn't seem to impact anything. All of a sudden, the world changed, and while it was unfortunate for our clients in Austin, I started seeing that as the potential initial domino here in the States, and sure enough, that bore out. So the cancellation started outpacing new booking confirmations around that time, and then that continued for a full month for us. So just to think about that, you're dealing with cancellations, you're dealing with refunds. There's a log jam, a backlog within each OTA where we distribute, and so you're seeing your numbers sort of fall, and then you're not able to replace them as normal. You're seeing your daily booking volumes go way down, and so really we knew it was going to be a rough ride right then. March total revenues ended at a level that was generally acceptable. I think part of that was just because of seasonality, and because this realization was hit sort of mid-month as opposed to earlier in the month for most consumers, and I think then it was in April, and we just didn't know how long it would persist. We were feeling the pain. We were trying to do anything we could, working to adapt, but April was probably about 40 to 45% of the budgeted total revenues. And thankfully things have opened up since May, and we can go into that a little bit more too.
And from your own experience in the sector, what would you say? What are the trends you're seeing with regards to revenue, ADR, length of stay, for example, as a result of the pandemic? And then from that, do you also expect these effects to be long lasting or to subside basically as lockdowns ease across the world?
Yeah, it's interesting. I don't think too much of this is permanent in terms of occupancy revenue. So ultimately, RevPAR. I think it will be a long recovery, and it's got to be layered on top of the backdrop of seasonality, and I think we can get lured into thinking that we're doing so much better right now, when really part of this lift is just seasonality starting to help. But still, I think this won't last. Corporate travelers will have to travel again, though that's still pretty minor. And leisure travelers, they want to get out, and we're seeing certain types of consumption now, namely drive market sort of consumption, and we're not even fully back. Some of our markets are still closed, but yeah, to speak to some of the data points, really from February to March, we had flat ADR, which that in itself is abnormal. Normally March with seasonality, that ADR increase would be material. And then March to April, this is where it got pretty ugly, negative 40% in terms of ADR. So thankfully, now in hindsight, it's a 1 month blip, at least for now. So we were up about 9%, so call it 10% in May in terms of ADR. And then May to June, we're not done. We're just starting the month really, but it's already up 15 to 20%. And so the trend looks good, at least for now. And again, we recognize that it's layered on top of better seasonality, and that will continue to improve through the summer. But we're not going to sleep on it either. We're going to continue to manage everything. In terms of occupancy rates, we definitely got hit, but with those ADR decreases, we were able to keep occupancy up at a decent level, at least in the markets we were allowed to operate. And so kind of went from 70% or so in February down into the 50% range in April. And then May was back up to 75+%. We should do that or better in June. Some other data points did shift too, which were kind of interesting to track. So things like length of stay and the advanced booking window just being how far out somebody plans their trip and goes ahead and books their lodging. Call it 2 to 3 weeks in a normal situation, maybe up to 4, depends on the time of year for our types of inventory. We saw that get down as low as 2 days, the booking window, back in April. And that was pretty scary because it's just hard to predict what's coming down the pike. You just don't have much of a view into any of these data points that we're talking about in the moment, because it's happening so last minute. But that is back up now into the looks like almost 30-day range now, 25 days or so. So that's been a great improvement. And then we did see the length of stay increase significantly. One of the changes we made operationally was to allow 30+ day stays, was something we never had done in the past. And so that plus the promotion by Airbnb of what they're calling midterm stays, I think caused a lift there. So a lift to the length of stay of about 2x. And then it also increased the percentage of bookings that we got, or percentage of total revenue, I should say, that we got through Airbnb as opposed to some of the other channels through which we distribute.
And then how important do you think it's going to be now for operators to be diversifying the channels where they're getting their bookings from now on? And how much, I know we've already talked about this a little bit, but how much of an impact do you think this is going to have on driving these high occupancy rates, for example, like we're seeing in states such as Florida and Alabama?
Yeah, I think it was important previously to be diversified across various channels and to invest in direct bookings as best an operator can. We're one that generally tries to go with the tide a little bit and just make sure we really optimize well on the OTAs. And then we have a direct booking activity, but it's really kind of centered around our clients and our clients' residents, almost like an amenity within their properties. So we don't push that too much out to consumers except to past guests. And we've done more of that during the pandemic. and that's been successful for certain markets and certain clients. We think that the midterm stay is a positive improvement. I think it's it's pulling in really a demand case that is more akin to corporate housing demand in the past, and I think you're seeing some of that shift as professional operators tick the trust and safety requirements and the duty of care. It opens up that door for that booking activity to actually happen on these channels. And at the same time, we've been pushing just generally to be exposed to that. So we're on corporate GDS sites, Sabre, Apollo, and so forth. We've even sought out other OTAs to the point of diversification. There's a military OTA now that we've started working with, Upstart, but they have some demand, and there's an overlap with some of our inventory. And so, while that maybe doesn't drive much in terms of our entire portfolio with a single property or a single client, a single unit that you're working to fill the calendar, working to drive returns, that can make all the difference. And so I think we'll continue to look for new channels, and then we'll also continue to work to optimize. But our trend had been a lower and lower percentage of bookings from Airbnb. And now that, that's actually shifted of late with this new environment, and we'll see where that shakes out.
And I guess my final question would be, speaking quite generally, but how optimistic are you now for the future of the short-term rental industry? Now we're seeing more of this verging towards mid-term stays. And when do you believe operators can now look forward to thriving rather than just and actually move on from this pure survival phase?
Yeah, well, we're there now, at least in my view. I mean, we closed out May, and it was on a really positive note, and we've been able to actually grow. We've been able to sign new clients during this downturn. So don't get me wrong, we didn't know where the bottom would be while things were falling in April, but we just took the approach of let's control what we can. Let's make some quick moves. So it was around the marketing and all of that, but it's also around the asset care. So increased cleaning procedures, using UV lights, gloves, wiping all hard surfaces, taking units offline if there's a suspected case, increasing the period from which the guest checks out and the housekeeping team goes in. All of these things were new and different activities for us, but I also think they may just be more sustainable going forward. We're dealing with the coronavirus pandemic right now in a vaccine-less environment, but we have, I don't know what it is, maybe half the population every year that doesn't get a flu vaccine, right? And so and then we have just normal coronavirus cases, not novel coronavirus cases, and maybe some of these new practices will limit some of that exposure going forward, and really have some positive effects. So we'll see. But yeah, I think the short-term rental industry is ultimately going to be positively impacted by this. And what I mean by that is, I think this has caused a reckoning with business models. I think it's exposed the weakness of the lease arbitrage model of short-term rental operators going out, leasing entire buildings, leasing blocks of units, and then seeking the arbitrage opportunity. But it's exposed the fact that that's really hard to do at scale. It's hard to do across, even penetrating a single market, much less, markets nationally or internationally. And especially when you're investing heavily in your own technology and you're building out a really, large team of the best and brightest that want to work on such issues. So I think it's caused a shift toward really our business model, the one that we were kind of crazy to launch with, I think, in the multifamily space back in early 2018. But, thankfully, we were able to gain some traction by 2019, and we grew by, really 5% a week, over 300% a year in 2019. And I think what we're going to see now is more competitive. Those that made it through this, they're going to shift into more of the revenue share model. Maybe there's some new hybrid that comes of it. And then, these operators are going to be forced, I think, even if they're VC backed. We're not. We're a bootstrap company that has just grown, and we continue to invest in our own operation. But we're going to see them have to worry about unit economics more. We're going to see them, work to deliver a great guest experience, but also be profitable. It can't just be about the top line growth. You have to manage both, which of course, right? And I think we're seeing the issues with speed over efficiency, at least applied in the real estate world, at best prop tech, right? So you still have to have your margins. You still have to run a responsible business, at least break even in a real estate related business.
Well, thank you very much for joining me today, Mickey, and for being the latest guest on the podcast.
Thank you, Paul.
And finally, just a reminder that you can follow all of the latest news, features, and opinions from the global short-term rental industry on ShortTermRentalz.com, where you can also sign up to our weekly newsletters, which come out every Monday and now on Thursdays as well. Thank you for listening, and we'll see you next time.